exposing the secrets behind successful businesses, starts with a simple click. Welcome to Business Diaries. Meet the Fed, America's money manager. The Federal Reserve is a very important bank in America. It is often called the Fed. Think of it as the main bank for the whole country. It is not like the bank where you keep your money. It is a bank for other banks. It also helps the government with money matters. The Fed has a big job. It tries to keep the country's economy healthy. This means it wants people to have jobs. It also wants prices for things to stay steady. The Fed was created a long time ago in 1913. Before the Fed, America had some big money problems. Sometimes, many banks would fail all at once. This caused a lot of trouble for people. People would lose their savings. Businesses would close down. The country needed a stronger system, so the government decided to create a central bank. This central bank is the Federal Reserve. Its main goal was to make the money system safer and more stable for everyone. The Fed is not just one building, it is a system. There is a main group in Washington, D.C. This group is called the Board of Governors. Then, there are 12 Federal Reserve banks. These banks are spread out across the country. Each regional bank serves a different part of America. This structure helps the Fed understand what is happening in different places. It helps them make better decisions for the entire nation's economy, not just one area. So, the Federal Reserve is like the head coach for America's money. It watches over the banks. It tries to keep the economy running smoothly. It makes sure money is available. It also works to prevent big money crises. Understanding the Fed helps us understand how our country's money works. It is a key player in the financial world. Many people watch what the Fed does very closely. Its decisions can affect many things. The Fed's big jobs keeping money safe and sound. One of the Fed's main jobs is to look after other banks. It makes rules for banks to follow. These rules help keep banks safe. If banks are safe, your money is safer too. The Fed checks on banks regularly. It makes sure they are not taking too many risks. If a bank gets into trouble, the Fed can help. This is important to stop problems from spreading. It's like a doctor for the banking system, always checking its health. Another big job for the Fed is managing inflation. Inflation means prices for things go up. If prices go up too fast, your money buys less. This is not good for people. The Fed tries to keep inflation low and steady. It has tools to do this. One tool is changing interest rates. Interest rates are the cost of borrowing money. If the Fed raises interest rates, borrowing becomes more expensive. This can slow down spending and keep prices from rising too quickly. The Fed is also in charge of monetary policy. This sounds complicated, but it is about managing money. It is about how much money is in the economy. The Fed can put more money into the system, or it can take money out. It does this to help the economy grow. It also does this to keep prices stable. This balancing act is very important. Too much money can cause high inflation. Too little money can slow down the economy and jobs. Finally, the Fed helps keep the payment system working. When you write a check or use a debit card, the Fed helps make sure the money moves correctly. It processes many payments every day. It also provides financial services to the U.S. government. It acts as the government's bank. So the Fed does many things. It regulates banks, it fights inflation, it manages the money supply, and it keeps payments flowing smoothly in the economy. How the Fed's choices touch your wallet. When the Fed makes decisions, it can change your life. For example, if the Fed changes interest rates, it affects how much you pay for loans. If interest rates go up, a loan for a car or a house will cost more. Your monthly payments will be higher. This might make you decide not to buy a car, or it might make you buy a smaller house. It can also affect your credit card interest rates, making debt more expensive. On the other hand, if the Fed lowers interest rates, borrowing money becomes cheaper. This can make it easier to buy big things. Businesses might also borrow more money. They can use this money to grow and hire more people. So lower interest rates can help the economy grow faster. However, if interest rates are too low for too long, it could lead to prices rising too quickly. The Fed always has to find the right balance for the economy. The Fed's actions also affect jobs. When the Fed tries to keep the economy healthy, it helps create jobs. If businesses are doing well, they hire more workers. If the Fed makes borrowing cheaper, businesses might expand. But if the Fed raises interest rates too much to fight inflation, it can slow down the economy. This slowdown could sometimes lead to job losses. So, the Fed has to be very careful. Its goal is to have as many people working as possible. Even the prices you pay at the store are linked to the Fed. The Fed tries to keep inflation low and stable. This means prices should not go up too fast. If the Fed does its job well, your money will hold its value. You will be able to buy about the same amount of goods tomorrow as you can today. But if inflation gets too high, everything becomes more expensive quickly. This makes it hard for families to afford what they need. The Fed's work aims to prevent this. The Fed's crucial role, a steady hand for the economy. The Federal Reserve plays a very important part in America's economy. Its main goal is to keep the economy stable. A stable economy is good for everyone. It means people can find jobs, businesses can grow, and prices for goods and services do not change too wildly. Without the Fed, the economy might swing up and down much more. This would create a lot of uncertainty for people and for businesses planning their future. One way the Fed provides stability is by being a lender of last resort. This means if banks are in big trouble and cannot get money from anywhere else, the Fed can lend them money. This helps prevent bank panics. A bank panic is when many people try to take their money out of banks at the same time. This can cause banks to fail. The Fed's ability to lend helps keep confidence in the banking system, which is vital. The Fed also works to achieve two main goals. These are often called its dual mandate. The first goal is maximum employment. This means the Fed wants as many people as possible to have jobs. The second goal is stable prices. This means keeping inflation low and predictable. Trying to achieve both these goals at the same time can be tricky. Sometimes actions to help employment might make inflation worse, and vice versa. It's a constant balancing act. In conclusion, the Federal Reserve is like a careful driver for the U.S. economy. It tries to steer clear of big problems. It uses its tools to keep things running smoothly. Its decisions about interest rates, banks, and money supply affect everyone. While its work is complex, its purpose is simple: to help create a strong and stable economy for all Americans. Understanding the Fed helps us see how our country works to achieve this important goal.